Have you ever wondered why some of the coolest investment opportunities, like getting in on the ground floor of a hot startup or putting money into a hedge fund, always seem to be off limits for most of us? Well, it's all because of a very exclusive club with some very specific rules. And today, we're going to pull back the curtain and see exactly how it works.
So let's just get right into it. What exactly is Wall Street's most exclusive club?
Well, it's a group of people known as accredited investors. And while that might sound a little dry and official, the rules for getting into this club are at the very center of a huge debate. A debate about fairness, about protecting investors, and really about the future of innovation itself.
Okay, so what is an accredited investor? Basically, it's anyone that the SEC, that's the Securities and Exchange Commission, considers sophisticated enough to handle investments that aren't registered with them. Think of it like a VIP pass. It lets you invest in higher risk, potentially higher reward things, like private companies, startups, and venture capital funds that the general public just can't touch.
Now, how do you get this VIP pass? Well, for decades, the keys to the kingdom have been surprisingly simple. It all boils down to two things. Either you have an annual income over $200,000 or $300,000 if you're a married couple, or you have a net worth of over $1 million, and that's not including the value of your main home.
But here's the kicker. This is the crucial point that kicked off the major government review we're digging into today. These rules, they were pretty much set back in the 1980s. And that just begs the question, right? Do rules from the era of Big Hair and New Coke really still make sense in today's economy? To really understand the debate, you gotta know the history. We have to look back at how we even got here in the first place. So let's check out the rules of the game and see how this all came to be.
Okay, looking at this timeline, you can see how this whole thing evolved. The idea really started way back in 1953, when the Supreme Court basically said investors in these kinds of private deals needed to be able to fend for themselves. But the key moment for our story, the big one, is 1982. That's when the SEC put those specific numbers on the board, 200 grand in income or $1 million in net worth. And besides a few little tweaks here and there, those numbers have stayed locked in for a very, very long time.
So why is this such a big deal? I mean, why did the U.S. Government Accountability Office, the GAO, do a whole deep dive report on this? Well, it's because the regulators are stuck in this really delicate balancing act that honestly affects everyone, from the tiniest startup to you and me. And this is the core conflict right here. On one hand, you have investor protection. The SEC's whole job is to protect people from getting into these super high-risk investments where they could lose everything. But on the other hand, you have capital formation. For the economy to work, new, innovative companies need to get money to grow and create jobs. If you make the rules too tight, you could choke off that funding and slow down the whole economy. Now, for years, there's been this one silent factor that's been messing with that balance, all without anyone changing a single rule. Inflation. I mean, $1 million today is not what it was in 1982, and a $200,000 salary isn't either. So inflation has quietly opened the doors to this club for millions more households. And that's raised some big concerns that maybe people are qualifying just because their assets have inflated, not because they're actually more financially savvy.
And wow, this chart from that GAO report really puts it into perspective. At the time they did the study, about 8.5 million households qualified under that $1 million net worth rule. But here's the crazy part. If that rule had just kept up with inflation, the bar would have been around $2.3 million, and only 3.7 million households would have qualified. That's a difference of almost 5 million families.
But remember that balancing act, right? This quote gets right to the heart of the other side's fear. You had angel investors and venture capital groups saying, hey, wait a minute, if you raise those numbers, you're going to shrink the pool of investors, and it's going to be way harder for the next great startup to get the funding it needs to even get off the ground.
So, if the old rules are clearly out of date, what are the other options? This brings us to the really interesting part, the actual solutions that were put on the table in the GAO report.
So the GAO didn't just point out the problem. They went out and surveyed 27 different market players for actual solutions. And what's really fascinating here is that all the suggestions basically fell into two main camps, both trying to figure out a better way to measure if an investor is sophisticated that goes beyond just looking at their bank account. So the first category still looks at your money, but in a much smarter, more nuanced way. Instead of just net worth, which can be all tied up in your house or something you can't sell, they proposed a liquid investment requirement. That means you need to have a certain amount of cash or assets you could sell easily. Another cool idea was a fixed percentage rule, which would limit how much of your total wealth you could gamble on a single private deal. Now, This second category, this is a much bigger shift. It's all about proving you actually understand the financial risks you're taking. This could mean you have to work with a registered investment advisor, or maybe you pass a test or you qualify because you have a certain degree or professional license. The whole idea is to move the goalposts from, can you afford to lose the money, to, do you really know what you're getting yourself into? So, after weighing all of this, what was the final word from the government's own watchdog? Let's take a look at what the GAO officially recommended in their 2013 report. And here it is. The bottom line from the GAO was crystal clear. They said the SEC should get serious about considering these alternative ideas. And they even called out two of the ones we just saw: having a certain amount of liquid investments and requiring the use of an investment advisor as probably the best ways to strike that all-important balance between protecting investors and helping businesses grow. And you know what? The SEC listened. In their official response, they agreed to take the report's findings seriously in their next big review of the accredited investor rules. So this GAO report basically set the entire agenda for the future of Wall Street's most exclusive club. You know, this entire debate, stretching all the way from the 1930s to today, it really just boils down to one fundamental question that we are still wrestling with. If just being wealthy isn't the best way to measure if someone is a smart investor, then what is? This is not financial advice.